Thanks for checking out this video from NetPicks. And today I'm going to talk about a candlestick pattern known as the Tweezer top and bottoms. Essentially, they're just two-bar reversal candlestick patterns. You can find them on any chart, any time frame, but just let me just say this. It's actually a potential reversal candlestick pattern, right? Don't want to say they're reversals because it may not even happen. So potential reversals, okay? It's not guaranteed. So we're looking for an end to the current trend. So we have two types of tweezer patterns that we're looking for. The first one is a tweezer bottom. It's a bullish reversal pattern, and it shows the potential end of a downtrend. Tweezer tops, bearish reversal pattern. It shows the potential end of a uptrend. Now there's really two key things to look for in this pattern. And the first one is the type of candlestick you have with the first candle and whether the tops or the bottoms line up. Now both tweezer types have that first candlestick as a long body, because that shows directional intent. For example, the tweezer bottom has a strong red candlestick, right? That shows that sellers are in control. Now the second candlestick, that can take many different forms. You could see a large body bar. You see doji candles, hammers, hanging mans. Virtually any type are fine. We also need to see this. Equal highs with the tweezer tops, equal lows with the bottoms. That's that characteristic with the solid black line. So do the highs and lows have to be exact? Any price action trader, any trader will tell you the markets are not perfect. Okay, and in trading, oftentimes close is close enough. So what does the tweezer top show? Now keep in mind that we don't trade the pattern. Okay, we trade what the pattern is representing. So with the tweezer top, consider an uptrend. Number one, the bulls are in charge here. They're driving that market up. You can see that with large bodied candles, right? It's the first candle in the pattern. The second one, the bulls are unable to make a new high price. So they see the failure of price advancing. Either they get out of their longs or new shorts now enter the market. So understanding what you are trading, you can see that the character of the first candlestick has an influence on the result of this pattern. The more bullish that candle is, the more potential we have for a reversal. This is an extreme example. Okay, the bulls ran into a resistance level, fell apart the next day. Longs, demoralized, battered, they bailed on the move, and you would have had longs simply profit taking after a large move after this happened. The bottoms. Tweezer bottoms. What we got? The bullish tweezer, just the opposite of the bearish tweezer. So here we have sellers, they're happy with their profits. Then price finds resistance, it starts to reverse. So the second day opens up, and for a brief time during that session, that candle number 2 would have been red because it makes a low off the open. So sellers that are sitting on the sideline, seeing this strong bearish candlestick of day 1, they think there's further downside still. And they look for a price to break the support low of candlestick 1. A price reverses, turns into a bullish candle. We can call that red to green. This could be an entry for longs. But those that are short from the first day, right, they're feeling the heat. So a true trend reversal begins, the market starts to make higher highs. So how do you trade them? To be honest, these patterns, they can appear often. And that depends on how tight your criteria is for matching the highs and lows. Personally, I like the first candlestick to have a large real body. It indicates less indecision, right, when that first candlestick's like that. So remember, we want strong conviction in one direction. We want that second day. That's the day that we want to see traders flip, right, to either exit their position or reverse their position, or other traders to jump in. Now, to add to the probability of at least some type of reversal, it would make sense to find these patterns at a support level, resistance level, or just at previous swing points. Tweezer bottom. So are you looking for a trend reversal or a continuation of the trend? So price is in an uptrend, makes a corrective decline. You look for a tweezer bottom reversal. Uptrending price forms a sideways consolidation, right? Traders look for the tweezer bottom, reverses near the bottom of the range or just under the support level. So here, the overall trend direction is up, okay? So at number 1, we find a tweezer bottom, right, at that bottom red line or just under the top red line. Number 2, that's a corrective decline reversal zone. And after reversal, price can often pause Tweezer bottoms can be played there as well. So you have 3 different locations that you can find one. On this chart here, price is in a downtrend. Tweezer bottom is put in at the red line, right at the bottom. It's a former resistance level off to the left. Now it's acting as support. Now finding reversals during a corrective decline, that can be pretty tricky, right? So using the Tweezer bottom to show a potential change in direction can add to your entry tools. How? I want you to notice the second candlestick. Often you will find that the second candlestick is an inside bar. An inside bar, that's just a simple consolidation on a lower time frame. So you can use a break of the high of the inside candlestick for your trade entry. Put your stop loss below the low of that 2 candle pattern. We're trading Tweezer tops. It's bearish, so we're looking for the end of an uptrend or a reversal off of the corrective rally of a pullback in a downtrending market. So this is interesting because we actually have 3 equal highs. However, that second candlestick in the middle is green. We want to see a bearish candle. So we get that as a hanging man in the third candlestick. Gives you a potential trade signal short. Here we have a bearish trend, a corrective rally. We see strong momentum bullish candle there. The Tweezer top candlestick pattern sets up. A former support level has now turned into resistance, and price collapses with a strong move, forming a bearish candle. Now that red one, that's still an inside candle. We can just play the break of the low of that once this sets up. My final thoughts. Tweezer pattern, what that really does, it shows the failure of a strong move to advance. So considering the theory behind the pattern, that's what we're trading. So we're looking for traders to exit positions or enter new positions when the price is failing to advance in the main direction. We can use confirming variables. We can use support and resistance zones. We can use technical indicators to help with reversal. And I would personally consider these as short-term trades at first. Price would then have to confirm a full trend change through price action or an indicator, if that's what you use for trend. Entries can be simple, just a simple break of the high or low of the second candle in the pattern. The stop loss, you place it above or below the extreme of the pattern. The bottom line, I always say this, ensure that you test out your trading plan before you enter the market with real money. That's it. Hope you find some value in this. Maybe add it to your current trading strategy. Hit like. Make sure you subscribe. We'll talk to you soon.